Good afternoon, everyone. Thank you for joining us for the second webinar of our Business Resilience webinar series on tracking farm performance. I'd just like to let you know that this session will be recorded today. And before we start, I would like to acknowledge that we are dialing in from what always was and always will be Aboriginal land. I pay my respects to the Kamilaroi people who are the traditional custodians of the land and waters on which I'm meeting today, and also extend that to the traditional custodians you're all representing today, as well as elders past, present and emerging. I'm Naomi Hobson. I'm a livestock officer and acting team leader with the Sustainable Ag team with Northwest Local Land Services. And as I mentioned, this is the second workshop in a 6-part series. Last week we had action coach Bianca Morrison on, and Bianca was discussing the importance of farm planning, setting short and long-term goals and planning action steps to achieve those goals. So today we have Rachel Dorning from Agri Financial Consulting, who is based in the northern part of our region, to discuss methods for tracking farm finance so that we can see which of those goals we can afford to cash flow and when we can afford to cash flow them. I'll give you an introduction to Rachel. Rachel's been associated with agriculture her whole life. She completed agricultural economics at UNE in Armidale before moving into banking, and spent the next 26 years across 2 banking organisations, from frontline manager positions across the Northwest until later years being a team leader for a team spread from Rockhampton to Sydney. In tandem with her banking career, Rachel has also built a farming operation with her husband in the background. And recently, with increasing farming commitments, Rachel started her own business, Agri Financial Consulting, helping farming families to navigate the nuances of the banking sector and to improve the performance of their farming businesses. So as you can see, Rachel is really well positioned to present today's session for us. If you have any questions throughout the webinar today, please type them into the chat box and we'll make sure that they all get answered before we finish up. And before I hand over to Rachel, we have 3 short poll questions for you to answer. I'll put these on the screen one at a time and give you a few moments to answer those before closing the polls. So you'll see these start to pop up in just a second. And if you could click on your answer for me, that would be really good. Thank you. So you should have the first question coming up there now. It is, do you use gross margins to help with planning and decision making? Just got a few more responses to come in there. At the moment, Rachel, we're sitting at 33% saying yes and 67% saying sometimes but not consistently.
Yeah, that's good.
All right. So we've had a few responses for that one. Is anyone else wanting to respond to that one? Okay, I'll close that one and we'll launch our next question. So the next one is, do you do regular cash flow budgeting? And that's just a simple yes or no.
Oh.
Everyone can see that on the screen now. Yes.
Wow.
That is fabulous to see.
Isn't it? That's excellent. I'm probably going to be preaching to the converted, I think.
That's all right. That's a really good point to start from, at least.
Yeah, definitely.
So I'll just close that poll down now and we'll move on to the last one. And so this one is, if you answered yes, how often do you review your cash flow? Annually, quarterly, monthly, weekly, or when I think about it?
Very good.
We've got a little bit of movement in there. I'm hoping everyone can see these responses coming up. At the moment, we have 38% saying quarterly, 50% monthly, and 13% when I think about it.
Great.
So I'll close that poll down now, and I'll hand over to you, Rachel. And just reminder, pop your questions in the chat box. It's up there on the top bar on the left. It's the little speaking bubble, and we'll make sure that we get all those answered for you. All right, over to you, Rachel.
Okay. Am I sharing the right screen? Let's start there.
Yep, I can see that one.
Yep, cool. I'll just move you. Sorry. Okay, welcome everyone. Thanks, Naomi, for that introduction and inviting me to present this topic today, tracking farm performance. We all know with the current cost of living pressures, this topic is very important, especially running into farm businesses or any business to speak of. Tracking farm performance is becoming important every day, and to know how profitable your enterprises are on an individual basis, but also your whole farm. With the fluctuations in cash flow in most agricultural businesses, it's critical to understand how to manage this. So today I'm going to go through the following topics: sources of information, gross margins, what are they? How to prepare a cash flow, the roles and benefits of cash flow budgeting, hints and tips on how to manage it, also how to change or improve your cash flow, and how often to review. Okay, firstly, I wanted to clarify some terms which are used that are interchangeable. I find that these two areas people get a little bit confused with, so I just wanted to clarify this up front before we start moving into the gross margins and cash flows. So costs are usually split into two areas: variable, direct, or operating costs. So those words are interchangeable but mean the same thing. And they are usually directly related to a particular enterprise, such as livestock or crops. And examples are fertilizer, seed, drenches, freight, selling costs. The other area are fixed or overhead costs, and these are all the other costs which cannot directly be attributed to an enterprise. So rates, general insurance, interest, and drawings. Okay, so required sources of information. To start tracking your performance, you'll need some financial data. I always say we don't need to reinvent the wheel, so start with what you have. This may be and can be accountants prepared profit and loss statement. If you have an accounting program, so Xero, MyOb, Phoenix, if you can generate a profit and loss out of your accounting program, but break it down into a monthly basis, will make it a little bit easier. Tax returns also have this information. Now, to move on to your income. So for livestock numbers, generally what I say is grab a piece of paper, back of an envelope, whatever it has to be, and write these categories at the top: timing of year, the category of livestock, the number, and the price. So an example is in March, you're going to sell weaners, you're going to sell 50, and the average price is 1,000 per head. So if you go through all your different livestock categories and do that you're going to sell throughout the year. Next area, if you are cropping, is to do the same with your cropping areas. So again, timing of year, area, yield, and price. So my example is in November, 100 hectares, 2 tonne to the hectare at $200. So gross margins, what are they? So a gross margin budget is the profitability of an individual enterprise. It's that total income for that enterprise less direct variable costs, and that gives you either a profit or a loss. So what's an individual enterprise? For livestock, this could be a weaner enterprise, a feeder steer enterprise, or a self-replacing merino or dorper enterprise. On a cropping side, it could be barley or wheat, cotton, sorghum. So these are all your individual enterprises. So why should we use it? The main one is to compare your enterprise returns. Comparing, and there's three main areas that it is quite important to compare your enterprise returns. So the first one is comparing like for like. So for example, it might be deciding whether you're going to plant wheat versus barley. In this particular area, it should always be comparing the same resources. So comparing grazing enterprises or comparing cropping enterprises. It needs to be the underlying same resource. And also you need to get it back to the same comparable or the most common denominator. And I usually say per hectare. And livestock, you could do it per DSC if you wanted to, but per hectare sort of can go across all multiple enterprises. The next one is what if scenarios. This gross margins are excellent for this. You can estimate the impact of changes such as price, yield, joining percentages or reproduction percentages, and seeing if you move one of those levers, what the overall impact is on your profitability of that enterprise. This is the strength of using gross margins. The other is to compare historical data. I use a lot with gross margin is going back historically and looking at how that particular enterprise performed for the last 12 months, for example. So it is really powerful going forward and planning and decision making for the upcoming 12 months, but it's also looking back historically as well and seeing how that enterprise performed. Okay, so now I'll take you through how to do a gross margin. And I'll firstly, with my tech savviness, I will show you where to get them. So the best place to find gross margin is DPI website. So I'll just bring that up. So here is the DPI website, and this is where the beef enterprise or beef enterprise comes up. Sheep are there as well. You can also find your I'll just go back into that link. It didn't work. And the other is cropping enterprises. So they are a little bit trickier to find. You need to go into old budgets in the archive section. And if you click on that, hopefully that'll work. And that will bring up all horticulture, pastures, etc. So that's a really good place to start to find what you need. Click back over here. Okay, so we'll start with income firstly. So again, referring back to that piece of paper where it had all the titles of monthly and what you were selling and the price and number of head you were selling, this is where that information can come in handy. So really it is just placing in and all that information on an income side and estimating what that's going to be. So this one is a little bit old, April 2023. It's not too bad, but pretty close to what we are today. But again, you just put in what you're going to receive and estimate what your total income is. Next one we move on to is expenses. So in the example for the DPI, they've sort of grouped all the expenses through. So what I've done is gone and found their assumptions to get to where they have. So they are detailed on the right-hand side. I'll just use my little laser pointer. So that's detailed here. So they're all the expenses that are included. And then there's also expenses that are not included. So you need to go through and work out what you utilize and for your, in this case, your beef enterprise. And again, also with their livestock selling expenses, they've also broken or put that all into one section. So I've just broken that out there as to what that means. So again, add all that up to get your overall total figure. Okay, so then we get to the final point. So you've put in all your income, you've put all your expenses in. So down here on the right-hand side, you get your gross margin. So in this case, they've got, say, $88,000. Now, these figures need to be quite high because they don't cover your overhead or indirect costs. So just to remember that this has to be profitable because it's still got to go and pay other expenses for the business. Now, they've also broken it up to the DSC factor. So if you wanted to compare across livestock enterprises, you can do it as a per DSC or the per hectare basis. So either of those you can then utilise to compare other grazing enterprises. Then over here on the left-hand side, this shows the variability that is in a particular enterprise. So you can see the variability here from 725 all the way up to 1,044. So the only thing I would like to highlight here is they're only moving price and or weight of the steers. So there's lots of other variables, and potentially there could be more costs associated with, say, putting on more weight as well. And that has not factored into these calculations. So it's purely just moving one or the other to get these figures. So just be mindful of that, that if you're focusing on getting an extra 40 kilos, it may not be achievable without using more inputs. Okay, so now that I've gone through all of that and calculated, there are some limitations to gross margins. And I touched on this a little bit before. So there's no overheads included. So your rates, insurance, interest, drawings, any of those types of things are not included. It also doesn't really factor in labour costs, in how much time it is required to do that enterprise. So there's no real reflection on the contribution of time into the calculations of these. So that is something that I believe needs to sort of go into these to understand whether it is a time-consuming enterprise or not. The other one is it's just a point in time. So it's when you do this, you're basing it on prices as you know it is today, or what you estimate into the future. So it is just what you believe it is today. How often to review? Look, I suggest to do it at least annually, especially in a livestock enterprise. Cropping, maybe twice a year, depending on whether it's winter or summer cropping. So at least doing aligning it with once you've finished harvest, for example, whichever crop it may be. An example of doing the gross margin, I suggest, is if you do have an accounting program, set up an enterprise allocation. So this is an example of from zero. So as you're coding your invoices through your accounting program, you can also be doing your gross margin information at the same time. So it's a lot easier to do it when you're paying that bill than to try and go back 12 months time and figure out what each invoice was for which particular enterprise. So my suggestion is, if to make it easier for yourself, is to go through and do it each transaction that you're doing. And also Xero, for example, does generate a report so that you can have a look at all your enterprises all on one page and see if you're overall profitable, but also having a look at each individual enterprise at the same time and seeing that if it is profitable. So yeah, that's my sort of finish up for gross margins. I just thought I would hand over to Naomi just to see if there's any questions in relation to gross margins.
Yeah, thanks, Rachel. We do have one that's coming from Todd. Good to have you here, Todd. I have seen opportunity costs included in a gross margin. Is that correct? And if so, when would it be applicable?
Opportunity cost. I haven't seen any opportunity costs, but I still think that it should be included. Opportunity cost to me is an example might be keeping grain for a period of time and the opportunity cost of not selling that grain at harvest, for example. So the cost of carry. But yeah, I do think that your overhead costs or any of those other costs need to come into a gross margin. So you need to be very careful of what's in and what's out in a gross margin and not make a whole business decision just on that one document is probably where I would say that. Answer that question.
That makes sense. Thanks, Rachel. I did have a question because quite often when we're talking with producers, they talk per hectare, per 100 mils of rainfall. What do you see the value of breaking it down as just per hectare, or adding in that additional step with the per hectare per 100 mils of rainfall?
Yeah, I suppose the per 100 mils sort of extends it out so that it can be comparable across a larger area, for example. So doing a gross margin for yourself, generally the whole property is receiving the same amount of rainfall. Okay, well, you would assume that's occurring. Whereas once you take it to the per 100 mils, that means you can compare it to Queensland or can compare it to out west and seeing whether, say, a Dorper enterprise is more profitable here versus out west. So I think the 100 mil one kind of opens up the comparison versus in area as well as just having a plain per hectare, because for example, on the tablelands, they can carry more stock per hectare than you can at Walgett. So to compare apples to apples, if you do it per 100 mils, that's closer or more realistic comparison than a per hectare basis.
Yeah, that's probably the best explanation of that I've received, I think. Thank you. There's no other questions coming through at the moment, so we might kick on. And yeah, if you do have questions, pop them in the chat box for us, and we'll do those at the end of the next little bit. Thanks.
Okay. Thanks, Naomi. Okay, so now we'll move into cash flows. What is it? So this is one of the key pillars for management of any business. A cash flow is an estimate of all income less expenses on a monthly basis and then extended over a period of generally 12 months. So why have I got the picture of the crystal ball? It's a cash flow gives you this power to look into the future like a crystal ball. It can let you know if you need more funds into the future. So why use a cash flow? Cash flows can give the business direction and can allow decisions to be made earlier. There are many things you can't control in agriculture, but a cash flow does give you some element of control and allows you to see the impact of decisions into the future. Garbage in, garbage out. So I always stress garbage in, garbage out with a cash flow. If it's not done properly, it can have detrimental effects on your business and usually results in the need to borrow more money, which further impacts the lack of cash. Own it. Make it a living document. Bianca mentioned this last week as well, making those documents, your 90-day plans, making them living documents. I also agree the same with cash flows. You need to continue to update these and mold them and move them forward so that you get the most value out of them. So keeping it updated, and don't be scared of it. It is better to have one bad day working through your budget for the next 12 months than wondering what you're going to do every day. And your goal is to have a positive net cash flow budget. Overall, putting your total income less your total expenses should result in a positive figure. A particular month can be negative, but the totals for the period need to net off to a positive figure. So back to my opening remark on your cost of living pressure. This links back to this point. It's hard to get a positive figure at the moment, and I've done plenty of budgets in the last 6 to 12 months, I can assure you. So it is really hard. But understanding the profitability of your enterprises and then this information flowing into your budget ensures you're maximising your returns. I will go through a few strategies a little bit later if it is negative and how to turn that round potentially. It's also good to remember that not all years are going to be positive. An example might be expanding your business, drought, floods. These may push the cash flow into a negative position. But what it does mean is you need to do some more work, and that means doing some more budget years to show when the budget will return to a positive position. Okay, so what I'm going to do now is just go through how to build your own budget. I've really simplified this down, so step by step, so you can then just take this and use these steps to build your own budget from scratch. So back to that little piece of paper that I said at the start with those categories, the timing of year, category number and price. This is where this comes in, and put this information into your budget. So in our examples, we had our wieners selling in March and we had our barley coming in November. So putting those two figures in, generally speaking, you'll have more entries than this, but just wanted to simplify it for today. Next place we move to is expenses. So use your profit and loss, or if you've got an accounting program, the breakdown into the monthly profit and loss. This is where you start with those two documents. I suggest so this information up the top, you can bring that directly across from your gross margins that you completed. It's just figuring out the timing throughout the year of when those expenses occur. The second part is in your overheads, and this sort of you can pull from your profit and loss statements, so whether they're accountant prepared ones or off your own accounting program. My suggestion is things like repairs and maintenance. You may not know now what you're going to spend in repairs and maintenance for the next 12 months. So pick that figure and then divide it by 12 so it goes in per month. The main critical part here is getting the overall total in there in expenses rather than getting the actual month right. Other things that you do know though are like rates, for example. You know when those come through and get paid. Likewise with interest, you know when your interest is due, so putting those in their particular months, and also your equipment finance, for example, putting them in. Now, my other sort of point to add here is if you do use your profit and loss statement, they could be up to 2 years old. So some of those expenses are going to be a little bit behind the times. My suggestion is to add 10 or 20%. You may not get it right all the time, but it's a start. I mean, the only thing would be interest, and it's tripled in the last 12 months. So it wouldn't work under that theory. But generally speaking, most costs will move up either 10 or 20%. So if you do get a movement like that with interest, my suggestion is, because it is a living document, is to move your interest costs up if there's an interest rate rise, so that you can see the impact of that rate rise on your own budget. Okay, so we've done income, we've done expenses, and now we move into our net cash flow. So this is really where the power comes in with your using your budget and looking into the future with your crystal ball. So on our example here, we have a positive net cash flow. So this is our circle here, the 32,000. So not too bad a position. It's positive. So that's after paying all expenses. So paying your drawings, all your business expenses, and your income has come in, and you've generated a figure of 32,000. So generally speaking, this is what's available to reduce your debt. Second point I would like to highlight is the red circles. So in this example, I've set up the overdraft limit to be $150,000. So these 2 points are where the client has gone over, or is potentially going to go over their limit. So this is where the crystal ball part comes in, is being able to look into the future and see what's going to happen with your cash. and making a decision. So we would have done this budget back in February, and we were able to identify that May we were going to go over the limit. So what did we need to do? So there's things like moving a income potentially a month. So in June there was income come in, so maybe moving that back into May to alleviate that stress point there. The other is maybe there was high expenses in April, maybe pushing those out past that May period to help. So it gives you lots of options as to how you can handle that. If you don't know that that's coming, the only option generally is to borrow more money, which then pushes more pressure onto your cash flow. So this is what I like with budgeting, is being able to see into the future and seeing these pain points, and then being able to make decisions earlier so that you can alleviate those cash flow pressures. Okay, so hints and tips. My main point is to keep it simple. Move your costs across from the gross margin. Don't try and reinvent the wheel. Just keep things consistent across both your gross margins and your cash flow. Keep the same category names as your accounting software. This really makes it easy, especially once you start to get into actuals to budget sort of space and comparing what you said you would do and what you actually did. It's really important to keep those category names the same. Aware of GST impacts. This is where I see a lot of businesses get caught out because they've kind of spent their GST money that they've got coming in, and then they can't, it puts a strain on their cash flow because they've got to find a lump sum. So my idea is to do your budget without any GST. So then it doesn't inflate the GST coming in and potentially what you're spending. The other is, in actual reality, is to put that GST somewhere else so that it is there when you need to pay it, and then it's not impacting and not getting spent out of your cash flow. The other one is to remember family drawings. I find in my banking days, this is where everyone comes unstuck, and I think, again, you need to come back to that simple terms. And my suggestion is to take a lump sum out each month for your family drawings and move it into another account, rather than running it through the business and not knowing how much is going into your drawings. The other is, it makes it really easy for the accountant, because they're not trolling through what you spent at Woolies, what you spent at Coles. It takes all of those expenses out and puts them into another account, which they don't need to see. And it also helps you, if you have your own accounting software, that you're not coding all these entries as well. So it really does simplify your overall management, and you can keep track of how much you're spending on your drawings because you're just transferring a lump sum into an account. Now, also with your budgeting, you should include capital purchases as well. Don't just leave it as your income and expenses everyday sort of things. You need to have capital items in there as well. And that might impact that net cash flow that I talked about, but at least it identifies what that need is, because there's usually other expenses associated with capital purchases. So definitely, if you're going to update a car or update machinery, you definitely need to have that in your budget, and also potentially where the source of funds is going to come from. Are you going to fund it out of cash flow, or are you going to get a loan or equipment finance to cover that purchase? Okay, so now we're going to go into how to change or improve your cash flow. So the first area obviously is to increase your income. And this can or may not be as easy as I say, but I've got a few ideas here. So by utilising your gross margins to run a more profitable enterprise, so comparing those enterprises again and picking the one that is more profitable than the other. I do just have a little clause here. I wouldn't suggest changing your enterprises around, because you need to factor in some capital improvements. So, for example, you wanted fine wool merino weather enterprise is more profitable than a cattle enterprise, but you need to have capital type items. You need to have a wool shed. You need to have sheep yards. So if you don't have those capital items, it's not so easy to make that movement. So that's my little disclaimer there. But generally, if you have the infrastructure to support that enterprise, you can change around or move them slightly to make more profit. Look at the productivity of your operation. So where are things that you can improve your carrying capacity or improve your yields so that you can get more income out of what said land that you have? One of my other pet hates probably is to sell unproductive livestock. Keeping something for when it's not actually generating any income, move it on, sell it, and be able to keep livestock that are productive. Another one, and this is what probably Todd sort of is touched on a little bit, is rationalising the cost of keeping grain. So having that opportunity cost of carry. A lot of people don't factor in keeping grain on farm and then the cost of not putting that into your overdraft. So you need to work out your carry costs and need to see whether that is worth waiting for another $10, $20, because you potentially are eating that up in interest anyway. So back to my example in this one, we had goat sales and cattle trading, so to improve their overall business. So they had feral goats. So that's where we generated a fair bit of money. And then also the season was good, so we implemented some cattle trading to improve their overall position. Now, I'll just touch a little bit on that table that we had earlier. So to move in our gross margin from the 880 to the top one of 1,044, that overall increase in profit is 18%. So all these little factors will add up and increase your income exponentially if you can make these types of movements in your enterprises on an individual basis, and then that accumulates up. So that's just something to keep in mind. All these incremental increases will add up. The next one is decreasing expenditure. I suggest, and again, looking at lots of budgets in the last 6 to 12 months, is reviewing each line item for savings. So this is really going through and obtaining quotes on a lot of those key items. So insurance, interest, phone, electricity. So a lot of those supplies that you have to have and are a key part of your business and that are high expenditure as part of a percentage of your income. So my suggestion is the larger ones, at least every 3 years. This is where it is a little bit time consuming because you spend a lot of time on the phone and trying to chase up those suppliers, but it is all worthwhile because, again, all those incremental savings that you get will help your bottom line. Next area to look at is lump sum payments. So this may be changing it to monthly or quarterly versus annual, and this will help with that cash flow timing. So back to that example where we had 2 pain points. So it might have been easier to, say, move their insurance costs from an annual basis to a quarterly basis and alleviate those pain points. So there are little things that you may do with managing these type of things to make it easier. The only thing is logistically is making sure you've got the money there on a monthly or quarterly basis rather than just paying it at an annual time. So there are some pros and cons around that one. Next one is review machinery. I know we all are the same. We all have something laying around the farm that we no longer require or it's outdated or whatever. So why not sell it? There's a good market these days for online to move these things on, and someone always wants it. So sell what you don't want, get that cash flow, get that capital back in to help with your cash flow. The other, which I mentioned before, was transferring a lump sum each month for drawings. So it works both ways. It simplifies on your business side, but it also helps you to monitor what is actually going out for drawings. Okay, so when to review? So my suggestion is, and I think everyone was either monthly or quarterly, so that's exactly what I suggest as well. So a quick check each month of your balance and to your budget. So in this example, you know, at the end of March, they were nearly 100,000 overdrawn. Look at what your statement is after you pay all your monthly bills and say, am I close to that or am I not? If you're about 20% over that, so in this case, if you're sitting at about 120,000, then you need to understand why. And it might be just a timing thing, that something you said was going to be spent in April, it's now in March. Just having a look at those little things and making sure that that is genuine. If it is something you haven't budgeted for, you know, the tractor blew up or something like that, then you need to understand what are the implications of that being at 120,000 compared to being at 100. So in this example, because your pain point is in May, there's going to be another 20,000 on top of that. So you're now nearly 50,000 over your limit in May versus what you said you were going to be, which was about 25. So this is where you start to sort of see the implications of looking into the future and saying, righto, well, I need to get onto this. I either need to reduce my costs or move costs around or move some sales around. And if you can't, then you go to the bank early. And they love that if you can go to the bank early and tell them that you're going to have this and you've looked at all your options and, you know, having a short-term increase is your only solution. But going early is much better than actually going after the fact when you're overdrawn. The next one is 3 monthly. So I always say align it with when you're doing something else. So align it with your BAS is easiest to be on a 3 monthly basis. In this one, I suggest that you deep dive into those variations. So if there has been extra expenditure, looking into the why of that, but also update these figures in your cash flow so you can have a look at the actual flow-on effects into the future. So this might be that because in our example, we had May was going to be out, but then that's really going to flow into your October as well. So being able to go to the bank potentially earlier and saying, look, I need this extra money, but that's because you're going to have 2 pain points in May and in October just before harvest. So I think this really gives you the power of being able to look into the future and seeing what impacts there are. Okay, so in conclusion, I just wanted to stress this. Understanding profitability of your enterprises to ensure you maximise your overall profitability. Using your cash flow to look into the future gives you options to address any shortfalls. Overall, the value in both gross margins and cash flow budget is to continue to review and monitor and owning it, making it a living document. Okay, thank you, everyone. Back to you, Naomi.
Thanks, Rachel. Pop your questions in the chat there, please. Just a comment with how well that ties into last week with the 90-day planning in particular. I'm thinking if you sit down, you know, at the start of the year or the start of the financial year and do your gross margins, spend a day plugging that into your cash flow and doing your 90-day planning. What a great chance to review as you do your BAS each quarter, to actually go on and review where you're sitting and, you know, put a line item into your 90-day planning to say, call the insurance companies and get updated quotes if that's something you want to be doing, and really plan that out to make the most of that and know where every dollar's going at that stage.
Absolutely, 100%.
Haven't had any questions popping yet, Rachel. But I know that we've spoken extensively for far too long at times about planning and things. I just wonder if you could just provide a bit of comment about your experience working with landholders and how this process of planning and knowing your cash flow helps when we do hit those high pressure times like drought. And the
Yes.
difference you see with people that have put the time and effort into this planning in the good times, and how that feeds into their resilience and ability to get through those real serious pain periods that are extended.
Yeah, look, I think the main thing is they know where their budget is, so they know how much cash they have available to look at those pain points. And examples are around whether to feed livestock or not feed livestock. Um, I always say that you need to have a purpose. So if you are going to feed, you need to have a purpose for feeding that animal, and that you have an end result, or knowing those that end result. So this is where the gross margin comes in. So when you do those gross margin, I think there's even a line on there that says drought feed costs or feeding costs. So it is being able to say, right, well, if I spend X into that overall gross margin, is it a profitable enterprise still? But the second point that I add to that is, yes, it might still be profitable, but then there's less profit to go around to feed into your overhead costs. So this is where the cash flow budget needs to come in and have a look at it. So I think it does build that resilience around understanding all the cogs and how they are related in a business when you get into those pain points, and being able to put that information in, say your feed costs, into your cash flow, and immediately know that you're going to run out of money. That's pretty powerful. So it can really give people it can really help in their decision making as to whether they do it or they don't do it. But also then be able to go to the bank and really present a case. If that's what they want to do, they really know where they're at. So I think these two areas, especially when things are tough, you know, really shine for people. And you can really tell when you're sitting in a bank manager's chair. You can really tell the people that are flying by the seat of their pants, and the people that are actually have done this and have worked out their plan. So I think it's very powerful. Gives you confidence as well. I think we haven't really talked about the human element of it all, but it does really help people. And that point around having one bad day doing your cash flow versus every day worrying about it, I can tell you, once you do your budget and you know where you are, it definitely helps your mental health, because you know what you've got to do. And you may need to bring it back down to, like Bianca said, on that quarterly basis, and doing it each quarter. But at least you can plan for that next 3 months and say, this is what I'm going to do. So the two sort of work together, I think, but it definitely takes the stress out. And that's what I can see is the human mental health impact of having this information.
Yeah, fantastic. Thank you. And a practical question: if setting up a cash flow in Excel, would you recommend adding a quarter on as you roll through the months, add a quarter on the back end and keep it as a living document, or start a new spreadsheet? What do you find is the easiest for people in terms of looking at it and utilizing it?
Yes. I suggest definitely keeping it a rolling 12 months budget, but it does kind of get a bit scary there when you start to sort of extend out. So yeah, I definitely what I do is I have a financial year, so I keep mine to a financial year, which helps me track my profitability at the same time. But it starts to get a bit tricky now, because you've got two budgets going. So that's when it sort of starts to get a little bit icky, because you've got to update one, then you've got to go and update the other. So, but yeah, definitely adding on that. I've seen it in my experience where people get caught out. So they may need more money, but it's in the next 3 months of that budget. So definitely having that extra or that visibility of 12 months out is definitely worthwhile.
Yeah, perfect. Thank you. I haven't got any other questions coming in at this stage, so I might launch the polls. So I've
Sure.
got one coming up now. This one is, do you feel more confident that you have the tools to help you budget and cash flow your farm goals after listening to Rachel? So yes, no, with some practice, I will are the options. So we've got 71% are saying yes and
Right.
29% are saying with some practice, I will, which is
Yeah.
fantastic to see.
Yeah. And it's definitely a confidence thing.
Yeah.
The more you do it, the more confident you will get with it.
All right, we'll launch the next one. So this one is, do you think you will utilize the templates we send on gross margins and cash flow budget? So we will send a copy of the recording once it's ready, and we'll also include the links for you so you can easily access those links to the gross margins and things like that for yourself.
Yes, and we'll send I do have a cash flow template that is in Excel, so that is something that people can use if they want as well. But there's lots of fancy ones you can use as well, but I find Excel's everyone understands.
Yep. So we've got 88% have said yes and 13% have said maybe, which is really good. And the last one that we have here is one for us. How did you hear about the webinar? So by email, social media, the Northwest LLS newsletter, word of mouth, or other. Seeing a few for the news. Oh, quite a good spread, which is really good.
Absolutely. That's
really
good
spread. Oh, we've got a little bit of movement there. All right, so I'll close that one now. I'll just quickly share my screen because we still have some more coming up in this series, which I'd like to let you know about and how to register for those. If I can find my screen today. Oh.
There's beauty of having multiple screens, and then there's downsides.
It does. It can make it a bit tricky. All right. Can you see that screen there?
Yes.
Yeah. So we've got Rachel coming back next week to look at bank ready things. So this is going to be talking through and extending on what we've done today, but what you need if you need to approach the bank for a loan, and also how to approach those tough conversations with the bank, as we've talked about. If you see that your overdraft is going to be overdrawn, how to actually have those conversations and when to have them. So that'll be a really good one. We've already got quite a few registrations for it, which is good. Week 4 will be tips for farm accounting and forecasting with Nicolette Vaughan from Principal Focus. They're an accountancy firm down in Dubbo. And this will feed into a lot of what we will have done in the previous 2 weeks in utilising programs like Xero and Figured to start to produce some of these reports and budgets and things in an easy way with all your information there to try and give you some time-saving tips on how to do some of that forecasting and scenario planning. Week 5 is managing staff and work health and safety with Beck Fing from House Paddock Consulting. Beck is based in Moree and has done a lot of this work across our region. She's really engaging with this, and we'll be talking through some of the practical aspects of both for staff and family that are working within your business, what things you need to be consider to manage outcomes effectively and also ensure that you're doing what you need to from a compliance perspective for work health and safety. So not a particularly glamorous subject, but a really important one to jump on board with. And in the last week, we'll be wrapping up with Dr. Jill Kelly from AHN Consulting. So Jill came last year and did a bunch of FEGAP workshops with us. And on the back of those, people are really keen to learn more and understand more about the economics of trading and how do we know what's a good trade, how do we run our figures, when is a good time to be trading. So we thought that would be a good one to put at the end. So once we really get a good handle on the financial capacity of our business and our goals, then we can look at when can we get the best bang for our buck with trading stock. So that's what we've got coming up. And sorry, I should have put on there, I'll put the link to where you can register for those. So if you've registered for these ones, just go to the Northwest Local Land Services events page, and there'll be a box there with the Business Resilience webinar. Click on that and you can go through and register for each of them. Unfortunately, you do need to register for each one to be able to attend each one. So please make sure to do that so that you don't miss any. And they're every Thursday, 1 o'clock for the next 4 weeks now. So you can jump on there. And just the last friendly reminder is we have our Northwest Beef Producers Forum in Warrialta next week on Wednesday. It's going to be a fantastic event with a really good lineup. So if you are in Warrialta or within driving distance, make sure to get along to that one because it's going to be a really fantastic event. We've got a great lineup of industry-leading speakers. And at the moment, about 14 companies coming along for the trade fair as well. So make sure to get along for that one. All right, we're just about onto our hour, so I think we'll wrap up now unless we've had any questions pop up. Oh, that's lovely. Just a thank you, Rachel and Naomi. Thank you for another great session. Thanks, very informative. That's fantastic to hear. Thank you, everyone. Really good. All right, thank you, Rachel, for today.
Thank you, everyone.
And hopefully we'll see you all next week. Thank
Excellent.
you.
Thanks, everyone. Bye-bye.
Bye.